Welcome to the latest edition of our Fixed Interests podcast series. I'm Rookmaaker, Head of Asia Pacific Sovereign Ratings. Today I'm joined by Jeremy Zook, a director in Fitch's Sovereign team and lead analyst for India. We'll be discussing the outlook for India's economic policies and for its BBB- rating, as Prime Minister Modi has just started his third 5-year term in office. So Jeremy, let's start with the politics. India held national elections during the second quarter of the year with the results announced in early June. Could you give us a brief overview of the election results and what the composition of this government looks like?
Sure, Thomas. So this election proved to be quite a bit more interesting and much closer than many analysts had anticipated. In the last two elections in 2014 and 2019, the Bharatiya Janata Party, or the BJP, under Prime Minister Narendra Modi, won an outright majority in parliament, and with their broader National Democratic Alliance, or NDA coalition, they controlled a rather commanding majority in parliament. Now, many analysts coming into this election thought the BJP would likely retain a majority, though slightly narrower than in 2019. But when the results rolled in, the BJP came away with 240 out of 545 seats, which was still the largest share of an individual party, but did fall short of an outright majority. Now, the BJP-led NDA alliance did win 293 seats, and that was enough to secure a majority in parliament and allow Prime Minister Modi to return to office for a third term. But this will be quite a shift for Prime Minister Modi, as for the first time as Prime Minister, he will have to rely on those coalition partners a bit more to move forward legislation. And this typically, involves greater compromise and policy trade-offs. And I think one other important thing to note is that the election did provide the NDA with a modestly weakened mandate, and we've seen certainly a more emboldened opposition from the Congress Party and their India coalition. And this could have implications for policymaking going forward.
So given this new reality, how do we see the economic policy agenda for the government over its 5-year term? And how do we assess the likelihood of significant economic reforms in this new political environment?
Well, I would say overall, we still expect relatively broad economic policy continuity, despite the government's narrower majority. And by this, we mean they will continue to focus on, many of the areas from their previous term around sustaining a large infrastructure capex drive, pursuing ease of doing business measures, enhancing digitalization, and gradual fiscal consolidation. And there does seem to be relatively strong buy-in from NDA coalition partners on these core issues. The government has also consistently, since the election, emphasized really the theme of policy continuity. And most ministries remain in the same hands as in the last government. And so the government's been kind of communicating a high degree of policy certainty for businesses and consumers. But now when it comes to, advancing some of the more difficult economic reforms, we do think that the return to coalition politics and the weakened mandate for the BJP will make it maybe a bit more difficult to move forward on significant structural reforms. There's still a great deal of work that could be done around factor market reforms, land, labor, and agriculture, which could structurally boost growth. But I think at the central government level, now we see those prospects as relatively limited in terms of moving forward, especially because those have always been controversial and difficult to advance in India in the first place. If we look at the record of the NDA in terms of reforms, it's a bit mixed since 2014. There have been some very successful reforms like the goods and services tax, as well as the insolvency and bankruptcy code. But other measures, I think notably demonetization, of course, prove less successful or perhaps even disruptive. I think more recently in 2020, the government pushed forward some pretty significant agricultural and labor reforms. But it did have to withdraw those agricultural reforms in 2021 in light of farmer protests, and the labor reforms are still seeming to be winding their way through processes at the state level.
Right. India has been garnering a great deal of global attention in the past few years as one of the world's fastest growing economies. How do we see India's growth outlook over the next 5 years, and what impact, if any, does the election result have on our view of the growth trajectory?
Yeah, that's right. I mean, India has been one of the fastest growing economies globally, and we do think that this is likely to be maintained. In FY24, so the fiscal year ending in March 2024, GDP grew 8.2%. We do forecast a slight moderation, but still very robust levels of growth, 7% this year in the current fiscal year 25, and 6.5% in fiscal year 26. So the government's core economic policies over the past several years have been focused on ensuring macro stability through sustaining relatively strong growth, containing inflationary pressures, and limiting external finance vulnerabilities. And this has been supported by relatively sound management at the Reserve Bank of India. If we look at the path of fiscal consolidation that we've seen, the government has done so while still boosting their infrastructure capex, and this has been quite supportive for economic growth. We do think that we've probably reached the peak in terms of the capex push this year, but we do think that it will be maintained at relatively high levels, and so that will help to underpin growth. When it comes to medium-term potential growth, we see this as relatively strong at 6.2%. Bank and corporate balance sheets are much healthier than they were prior to the pandemic. And this improvement, we think, should facilitate an acceleration in the private investment cycle, which will help to underpin healthy medium-term growth performance and then allow the government to kind of ease off its infrastructure drive to a degree. There are risks to this outlook, of course. I mean, we haven't seen what, in our view, constitutes kind of a durable acceleration in private investment. If consumption remains a bit tepid, there could be less incentive for private investment, though our expectation is that consumption will pick up as it did in the last quarter. Now, the weakened ability that we discussed already to advance some of these major reforms at the central level, this doesn't really pose downside risks to our medium-term growth forecasts, but it does limit, I think, the upside potential to those estimates. Prior to the election, we had not really assumed significant progress in these factor market reforms anyways, so it doesn't really lead to a change in our base case. And we do still see, the possibility that there will be progress on land and labor reforms continuing at the state level, which should help to boost India's growth and manufacturing opportunities.
Thank you, Jeremy. Let's turn to fiscal policy now. So in some of our recent commentary, we noted that we've seen improved fiscal credibility and transparency in recent years as the government has pursued gradual fiscal consolidation. What led to this shift in view, and how do we see the fiscal trajectory going forward? What are the key risks to this improved fiscal path?
Yeah, I mean, there have been very clear improvements in fiscal management in recent years. To touch briefly on the transparency aspect, in the years prior to the pandemic, the central government did rely quite considerably on off-budget fiscal spending. So this really made it a bit more challenging to assess kind of the true fiscal position. Now, since fiscal year 21, the government has made a commitment to stop its use of off-budget operations, and it does appear to be holding to this so far. Fiscal credibility has also been improved, and this has been demonstrated by the government's recent ability to achieve, and in some cases outperform, its fiscal deficit targets in recent years. So for instance, in fiscal year 24, the central government fiscal deficit was 5.6% of GDP compared to the original budget target of 5.9%. And more recently, in the current FY25, the deficit target was revised down to 4.9% of GDP from 5.1% in the post-election budget that came out in July. I think, this improved performance has been what led to our change in our expectations as well. We kind of long thought it would be very difficult for the central government to achieve its medium-term deficit target that it set for itself in fiscal year 22, and that was, reaching a deficit of 4.5% of GDP or below by fiscal year 26. So we now see them as achieving this target, and I think it's also important to note that even with the elections where there's generally a bit of pressure for greater social and subsidy spending, we did see a reduction actually in subsidy spending, and this does, I think, signal a bit of commitment to achieving fiscal targets and improving spending quality. All that said, the pace of consolidation has been relatively gradual in nature, and the deficit has come down by just 1.8% of GDP since fiscal year 22, as the government has kind of sought to balance its growth and fiscal consolidation objectives. Going forward, we do expect the government to continue on this gradual consolidation path from a deficit of about 4.4% of GDP in fiscal year 26 to 3.8% by fiscal year 29. But there's still not a great deal of clarity, I think, on the medium-term fiscal objectives. We do think that we'll get greater clarity in coming years. The government has hinted at a desire to keep debt on a downward path and manage fiscal deficits so as to be able to do that. I think we'll see kind of more details around that in upcoming budgets. Now, when it comes to the risks, there are still risks to fiscal consolidation around growth underperformance and politics in particular. Strong growth performance has contributed to pretty buoyant revenues in recent years, but this may kind of shift in the coming years. And secondly, as I mentioned, we do think the government will ease off its infrastructure drive, and that will help to support consolidation. But if private investment doesn't really pick up more durably and take up the baton from government capex, that growth and consolidation trade-off could become more challenging for the government. On the political side, of course, the government has been able to kind of steer clear of populist measures to a large degree, and been able to manage demands from coalition partners. But as time goes on, especially depending on state election performance, we could perhaps see some fiscal slippages from these political challenges.
Let's end by turning to the sovereign rating, which we affirmed a few weeks ago at BBB- with a stable outlook. So far, we've spoken quite a bit about some of the positive trends around growth and fiscal consolidation, but the deficit reduction has been relatively gradual and public finances remain a rating weakness. Could you give some more details on how we view India's public finance situation from a ratings perspective? And what are the key factors Fitch is watching that could drive a positive or negative action in the rating going forward?
Yeah, we have seen quite a bit of positive momentum in many of the credit metrics, even on the public finance side. But I think we have to take a step back and look kind of from a structural perspective when it comes to public finances. A lot of India's metrics are still quite weak compared to BBB peers. When we look at, on a general government basis, the deficit, it's around 8%. Debt is still just over 80% of GDP. And importantly, the interest to revenue ratio is 25%, which is quite a clear outlier compared to peers. So even with this progress, there is a structural public finance weakness in India's credit profile. As we see continued progress in the fiscal consolidation area, that's something that we'll be watching quite closely in terms of our upcoming rating decisions, and this is one of our key positive sensitivities. If we gain more confidence around the government's ability to put debt on a downward path, I think that could be a potential trigger for a positive action for the rating. That's what we lay out in our rating sensitivities. And, when we think about the growth aspect, this, of course, plays an important role in this downward debt trajectory. If we think now about our own forecasts, they are still very sensitive to growth outcomes. And if nominal growth slips kind of below double digits, it does make it difficult to put debt on a downward path. So we'll be also watching very closely kind of our views on medium-term potential growth and whether that pickup in private investment proves to be durable. And growth, should help to improve other structural metrics, India's share in global GDP, as well as per capita GDP on a relative basis. On the negative side, I think we're kind of looking at potential triggers that are kind of the opposite of those positive triggers. If we were to see a sustained upward trend in that debt ratio, that would be a potential trigger for a negative action. Or if growth were to significantly underperform our current outlook for medium term.
Thanks for your insights, Jeremy, and thank you all for listening. For more information on our ratings and on our research on India, please visit us at fitchratings.com. We hope you will join us for the next edition of Fixed Interests.